Welcome everyone to our end of year webinar and Q&A for the Hyperion Fund LLC. I'll be answering all of your questions at the end. Feel free to send questions in at any time. Today we'll be recapping the year so far for Hyperion Fund and introducing you all to 3 of our 7 portfolio managers that trade the Hyperion portfolio. For those of you not already invested in the fund, the Hyperion Fund is a multi-strategy hedge fund focused on generating consistent returns with a low level of volatility. We also aim to maintain a low correlation to the equity market. When I say market in regards to the Hyperion Fund, I'm referring to the S&P 500. The lion's share of what we trade in the Hyperion portfolio are options on the ES, which is the futures contract for the S&P. Why did we create the Hyperion Fund in the first place? Our mission during the development of the Hyperion Fund was to find an answer to this question. What is the best way to reduce drawdown, manage risk, and still provide an attractive return? In other words, what does it mean to create a truly all-weather portfolio? Creating a true multi-strategy approach with purpose and not just diversification for diversification's sake. Who did we create Hyperion Fund for? When my partner John Paul and I started this fund, we were building something to meet the expectations of how we would want our own money managed and the money of our families. That's why we're investors in this fund. The fund was created for high net worth individuals and their families because we believe it is an excellent investment to preserve wealth and achieve long-term growth. Hyperion was also created with registered investment advisors in mind, those that have been trusted to manage their clients' wealth and allocate it responsibly. All right, now we're going to talk about 2024 for a little bit. 2024, we saw a strong bull equity market, only had short-lived, sometimes aggressive bouts of volatility. Our portfolio is intended to be a carefully considered balance of market neutral and long volatility strategies. We therefore do not typically outperform our historical averages in a strong bull market, but we do expect to shine in a bear market or a relatively mild returning year for the S&P. There are a couple standout months in our year. They're nearly identical in size, one being positive, which was July. The other was negative immediately following in August. In July, our portfolio worked exactly as designed. We saw strong market moves in both directions in July, and we were well positioned to capitalize on both sides, posting our best month of the year. Unfortunately, we immediately gave those returns back the following month. Our portfolio weightings among the strategies remained static from the prior month, as we intend to do every month, giving us the highest probability of a favorable outcome. Our fund has shown its ability to handle major market declines numerous times over its history. Unfortunately, to start August, our long vol portion of the portfolio had been harvesting profit at the end of July. And the move that came right at the start of August occurred when our portfolio was skewed to the market neutral side. Our market neutral strategies stopped out at maximum loss limit levels, while the long vol portion of the portfolio was unable to profit from the move. The short-lived market crash quickly reversed during the following session, making the newly established long vol positions lose money while the market neutral strategies were waiting for calm before re-entering. In the future, our long VIX butterfly trade that exists in our vol capture strategy will be used as a short-term hedge, meaning we have a process in place to evaluate the balance within the portfolio and can quickly hedge out uneven risk by increasing a strategy that's already trading in the fund. The VIX market is open 23 hours a day, making it a viable solution to this rare occurrence. This was our first negative month in the last 4 years of trading. Although we will have a drawdown in the future, we do hope to minimize the size of it to a considerably smaller number. Some stats for the year. We entered December at 9.01% for the year, and we're up about 0.5% month to date. That would put us likely around 10% for the year by month end. We've maintained a sharp just over 3 and a correlation to the equity market of negative 0.12. Now I want to give everyone a chance to hear from some of our portfolio managers. I've asked 3 of our head traders to join us today. We are joined by Jungtao Du, who manages the directional spread strategy, Make Kaminsky, who manages the active range strategy, and Mark Adams, who manages both the tactical and strategic strategies. Together, they represent 4 of the 8 strategies currently traded in the Hyperion Fund portfolio. Rather than have each manager just explain their strategy, we're going to discuss how the strategy would respond to a market event. We're most often asked about the impact of a market decline, so that's what we're going to focus on today. We'll have each trader discuss what actions their strategy would take to either manage risk or capture profit. Using the historical data on black swan events shows us that most single-day S&P declines are in the 3 to 5% range. One day in 2008 was about 9%, and one day in 2020 was approximately 11%. This slide is going to show you how the VIX has responded to such moves. Starting with Mike Kaminsky, would you discuss how your strategy is positioned in the market, how it is designed to profit or manage risk in such a move, and how you would respond to a market decline? Mike, thank you for joining us.
Good evening. Thanks that I can take part of it, and welcome to everybody here in this webinar. So, yeah, come directly to your question. We can start in 2008 and in 2020 with this large daily down moves of 9% in 2008 and over 11% in 2020. What is important for the active range is from which environment this happened, as in the past. So what is important is the volatility index one day before it happened. And also in 2008 and in March 2020, the VIX was around 55 one day before this large down move happened. And if the volatility index is over 40, we need a big down move to make a profit. In this market environment, our risk starts if the market moves down more than 20% on a single day, and the VIX is at 55 because you have a lot of market interruptions before. So in 2008, it started in September with the Lehman crisis. And in March 2020, it started in the last week of February, when we have here the corona situation worldwide and the shutdowns around the globe. So for us, it's important, where is the VIX one day prior? The second question is the black swan. Black swan means it happened out of the nowhere. So it happened if everybody is in a Goldilocks scenario, for example, as we have it now. The market moved to the upside, and everybody think it goes the next days, the next months in the same level. And then you wake up Monday morning or Wednesday morning or whenever, and the market goes to the downside, open 3% and move, for example, to 5%. This is also an environment in the past where this environment was profitable for active range, because we need at minimum a 4% down move to create profits. So from low volatility, every down move from 1-2% to 6-7% is positive for us. And at 7%, it changed. So if the market dropped more than 7% in a single day, only in a single day from a low volatility environment, then our profit will go down and change to a loss. But intraday, we have the possibility to close spreads. We have developed an in-house risk management model, and we see in advance when this changed, and we can close position before. So for example, today, the best case will be a down move of 5.5%, and we will lose money if the market drop more than 8%. So if the market goes to a loss of 4%, we will start to take profit, and on the other side to reduce the risk. And then we can make profits. And at the end, it's okay when it's a closing bell rings and the market is around 8% in a loss, because we take profits with positions that don't make a profit if we wait till the market is 8% in a loss. So for the Black Swans event, and also we have 4 Black Swans in the last 3.5 years, we were profitable on each day when this happened. This is not a problem for us. So we need this 4% down moves. So for us, it's important that we see pullbacks. Equal if it's 4% in a single day or over 2-3 days or in a week. For example, this year, our best week was the first week of September. The market dropped a little bit over 4%, and we make a profit of around 4%. So this is my answer about it.
Thank you, Mike. I appreciate all that insight, and that's super helpful. Why don't we talk about the times where your strategy is not meant to profit and it actually does give back some of the P&L that you've generated, which it would be in a bull market, right? So 2024, strong bull market for most of the year. Like I said, we had short-lived bouts of volatility. You guys held your own well. How do you manage to make money on the down move of the market, but not lose alongside the market when it goes up?
So the last 52 weeks was a worst case for us, but at the moment we are a little bit around 1% on the upside in this worst case scenario, because we are trading put spreads only on the S&P 500 future. So in a spread, we are buying puts and we are selling puts, but we pay premium. So we pay more for the bought options than we receive for the sold options, and we invest a premium of around 3 to 4% in a year to achieve our target of around 10% profit in a year, but we need pullbacks. And this year we have only a pullback in April, and then this Wolmageddon at the beginning of August. We were a little bit on the upside in this environment, but after 3 days, the market starts a big rally to the upside. And in this rally, we lost what we earned in the beginning of August. So then we have only the first week of September, and since then, the next rally started. So for us, is this a very problematic environment if you have this bull market without pullbacks? For example, 21, you have also you were 27% on the upside in the S&P, but we have seen 5 pullbacks in 21, and on average we make a performance over 11%. So for us, it's not important if the market can go to the upside, and we think on a longer way that the market goes to the upside, but we make profits if we have a pullback. And in the last 3.5 years, we have a negative correlation of -70 to the traded index S&P 500, and we make a performance of 28%, and the market goes up 40%. So we are only 12 points behind the market, but with a negative correlation of 70 basis points. So I think in a portfolio context, it makes sense to invest in the Hyperion fund or to invest in some single strategies with a negative correlation.
Thanks for all that detail, Mike. And I know following this call, I'll get questions about 2022 and why our performance was relatively flat. And I want to make the point that you were introduced to the portfolio in 2023. Can you talk a little bit about your portfolio in 2022 for investors that are worried that we're going to go into a recession or another bear market environment?
Yes. So 2022 is a very profitable situation for us. It's one of the best situations where we can make money. We were profitable from the first 9 months, from January to September. We were profitable 8 months. We only lose 1% in July, so it was also the maximum drawdown. And where the market goes down 19% in the first 9 months, we make a performance over 15% in this time period. So it depends here, the negative correlation -70, -80 points. Because of the structure that we only trade puts, we are buying puts around 1% out of the money. And depending from the volatility, we are selling out of the money puts. In 22, we were 15% out of the money, but only time to expiration 3 weeks. So best case for us is that the market don't move 15% in 6 months. For us, it will be the best if the market move down 50% in 3 weeks. Then we produce and can produce the highest profit, for example, because the volatility was every time over 20, sometimes over 30. You have a high skewness level. It means that the volatility for out of the money puts are very high, and it's very attractive for our strategy. So if something happened again, we are well prepared, and I think this will be a very good environment for active range.
Okay. Yeah, thanks, Mick. I appreciate that as well. We are going to go ahead and move on to the next trader here, Jingtao, or no, excuse me, Jingtao. I'm sure Jingtao gives. All right, Jingtao's joined the call. So I appreciate you, Mike. Thanks again. Appreciate you joining the call. We're going to go on to Jungtao Du. Jungtao is one of the founding members of the portfolio team for Hyperion Fund. So he's been a part of the portfolio from day one. He shares our conservative nature, and we're going to hear a little bit more about how he trades and what he would do in an environment like we just described with Make. You can give us just a second. He's joining here now. While we're waiting, I'll introduce him a little bit. Jungtao. Oh, here we go. Hi, Jungtao. How are you? Oh, Jungtao, your mic is you got to turn the mic on there. Jungtao is the head trader of the directional spread strategy. He would be in the market neutral bucket of the two types of strategies that we allocate to. Like I said, he's been trading with us since the inception of Hyperion Fund and is a focal point of the portfolio. Hi, Jungtao. How are you?
I'm good. I'm good. Can you hear me?
I can hear you well. Do you hear me?
Yes. Okay. Yeah, my name is Zhang Du. I manage the part of the strategy that's called uh ratio spread sort of a strategy, directional ratio spread strategy. So basically, what I do is to try to put on certain positions, and then while I put any position on, I tend to like put a lot of hedge for the set position on. And typically the way I hedge is not just to hedge the exposure. I tend to over hedge the exposure because of the market sometimes has a lot of like sort of violent sort of a tendency to do like really fast and big magnitude moves. So we don't want to be caught sort of off guard. And that's what I do is basically my investment philosophy is to make some sort of modest absolute return. However, the same set of return can be characterized as very high quality, sort of high Sharpe ratio return. If you put that in a sort of risk adjusted return sort of framework. Typically, I only like trade E-mini options with a day or two to expiration, and the vast majority of these trades actually focus on the 1 day sort of expiration E-mini options. Um, like I heard Mike talking about how his strategies would start making money when the market drops like 4% or even lower. From that point on, he's making money. So to follow the same thread, I would say the way my sort of a composite position works is that whenever market drops between like 1 to 2%, those are like kind of the area where I'm starting to have my long exposure, my long options sort of started almost like in the money situation. So I started to make money as the market moved down, like towards like 1 to 2% sort of range. Otherwise, I don't make any money because the entire set of options would all sort of expire worthless. Um, so I guess Mike covers the greater than 4% sort of downturn, and me, I would cover starting to have like piano like when it's like 1 to 2%. Now the rest of the massive situation of market doesn't do anything. In order to make this a viable strategy, what I construct sort of a portfolio for everyday sort of positions would be such that on a net basis, typically, even after the hedging, I still have a little bit of extra money, like taking in extra income, so that if nothing happens, my small extra income tend to make small amount of money, contributing to the Hyperion sort of portfolio. Um, so that's what I do. And in terms of its actual performance, so my strategy has been around for like 10 to 11 years. And typically the characteristic of my portfolio is such that whenever there's a spike of risky sort of assets getting really, really plummet, that's when I actually shine. So for example, case in point, this year in early August, there's a very sort of renounced sort of event, the Japanese carry trade unwind. When that happened, actually the VIX quickly went above 50. I think that was in the middle of the night, August 3rd or 4th. I don't remember exactly a date, but that was the magnitude. And then typically my strategy tends to have potential to make big gain whenever that happens, just to give you a taste. Let me see, what else can I talk about? Um, Now, the way I put on the, sorry, Tyler, you wanna chime in?
No, I'm sorry. I didn't mean to interrupt you, Jung Tao. I wanted to maybe touch on a point that you brought up. So you mentioned that you like the short expiration, and for the majority of your trades, their next day expiration. Why do you
Right.
keep the expiration so tight?
Because the shorter time to expiration, the easier to manage the portfolio. So my goal is to create something a little bit like too good to be true, but by most standard. So I want to create a portfolio with a little bit positive carry, but at the same time, it actually has positive convexity or positive gamma. Now, typically, like it's impossible to do that. In order to have positive carry, you have to sacrifice by like, negative gamma or something. Uh, but I managed to do this, not every day, but most of the days, to have a portfolio that's positive carry, positive convexity, and this is because the particular market I trade has this very persistent uh, sort of structural inefficiency, the E-mini S&P market. And like I said, like the shorter to expiration, the easier to handle all the sort of market move. That's why I tend to like the 1 day. Back in the days, like 10 years back, there's no like 1 day option. I think, yeah, it's at least like it's weekly option. So every Friday there's a particular ticker that start trading. So let's say, by this Friday, if I want to put on a position because my current Friday position would expire, I typically will put on like 7 days later, next Friday's position, which makes it very, very hard to manage. So my entire history of my sort of strategy, there's basically only 1 month down. It's like down 1 point some percent. And that was during the when these options don't have 1 day, they have like 7 days minimum till expiration. And then that was like the event of Chinese currency devaluation. It's in August of 2015, so I lost like 1 or 2%. That was my entire sort of a negative month, basically, for my last 10, 11 years. Um, I don't know, Tyler. What else do you do you think I should talk about?
No, that's super helpful, Junktown. I just want to clarify for the audience, when you say that you have a positive carry on your trade, you mean that if the market does not do what you hope it would do, which is accelerate towards your long strike price, then you've sold that position as a credit. So you will make money if the market goes up or stays flat. You have this position on, it will expire, and there will be a credit to Hyperion Fund. Correct?
The positive carry is, I guess it's bond market lingo. I used to trade bond market, so the big focus is like whether this trade is positive carry or negative carry. Positive carry, simply put, is just that when you buy and sell a bunch of options, net, if you take money in, then that's called positive carry. If you don't take money and you actually like pulling money out, that's called negative carry. So as you can see, if I have a portfolio to start with, I take in some money, and then if nothing happens, I get to pocket that money because I have positive carry. So in that sense, yeah.
Absolutely. No, that's great, Jungtao. I appreciate your time and explanation. We're going to move on to Mark Adams. So Mark Adams trades two strategies within the fund, both the strategic and the tactical strategy. They're two very different strategies with different purposes. So we'll let Mark kind of expand on the question that we're talking about, and also talk about how the two strategies would react to a market move. Hi, Mark. Thanks for joining us.
Thanks, Tyler. Appreciate it. And appreciate everyone taking the time today to learn more about what we're doing here. So it does sound like we kind of fit in between the two other managers nicely, having heard what they've had to say. You know, I'll talk about both tactical and strategic, but in a sense, they're both founded on the same research, and it's just a different expression of that market opinion. Everything we do is short term. It sounds like we kind of fit in between Mike and Juntao. We will go around 1 to 1.5 weeks before expiration, and we'll use S&P futures options, the minis now. Now, you go back long enough, we were trading the bigs, and I've been doing this since 2002, so it's been around for a while, been trading these markets for a long time. But back in the day, we were doing the open outcry pits, obviously transitioned to the minis. But the way I use the options in strategic, if you look at it that way, it's similar to a couple of the managers where you need a degree of volatility to do its best work. There is a slight negative carry to it. We're spending a small debit to buy multiple nested ratio put spreads, usually, like I say, 1 to 1.5 weeks before expiration. So generally, there'll be 2 to 3% out of the money on the long, upwards of 8 to 10% out of the money on its terminal risk point. What it does like to see, it'd like to see a little volatility. It needs it to happen rather quickly. Sometimes you have a volatility expansion, like in August. We made some okay money there, not as good as we'd like to have seen, but simply because of the massive volatility move. Had that type of price move been accompanied by a lower volatility move, maybe less Volmageddon panic and more of a just generalized sell-off, that would perform much better. Over the long term, it does need a degree of movement. So if we see a situation where the market opens and just grinds higher like it's been doing, we're going to chew up that debit, and it'll be pennies here, nickels there kind of situation. But there is a negative cost of carry to the strategy. It does like to see a little degree of movement. It is essentially long volatility, but out of the money, and eventually it will be. There is short options exposure, but again, it's significantly below the market. Risk management is part and parcel to the strategy. Once the market starts moving, we're either looking to, offset some of the risk or monetize trades. Generally these are, 1x2 strategies in multiple instances of them over the same expiration. Sometimes just a 1x2. Most times it will be multiple 1x2s on the same expiration to create multiple profit opportunities along the S&P's kind of payoff structure. So that's strategic. Strategic has been trading since January of '97. I didn't mention that, but it's got a lot of pretty long track record here now. But it's seen a lot of different environments, generally trading the exact same way over time. it's very different than tactical, even though tactical is founded on the same research, the same underlying, market, kind of indicators drive both programs. The expression of those is different. Tactical will buy put spreads, we'll go long, put deep out of the money, and short a ratio 2 or 3 deeper out of the money to take in a credit. So we're still long a put spread, but it has a positive delta to it at onset, so it's got positive carry. So essentially, what we're doing there is taking in premium, although there is a degree of protection built into it. So what it does its best work with moderate volatility. It doesn't want to see the market go, straight down and have a 50, 60 VIX handle from a 20 VIX handle the day before. That's where our hedging has to come in, and we're very aggressive at doing so. That strategy started in May of 2012. So it too has seen a number of different environments and has had pretty good consistent returns. The way I like to describe it is tactical makes slow, steady money, whereas strategic will make lumpier returns. And their returns over time have been, surprisingly similar, depending on your fee structure, et cetera, of course. But, over time, they have very little correlation to one another, almost zero, almost perfectly non-correlated, even though it's the same markets, same instruments, same fundamental research, but it's a very different expression of that research to either collect premium, essentially, in a protected manner, or to have a long vol expression, or a kind of I call strategic kind of a gray swan fund. It wants the market to go to fall out, and wants it to sell off. Doesn't want it to see it go to zero. We're not that type of trader. We're not looking for a down 25% a day. I don't think any manager here would say that either, but that's a very different strategy than what we're pursuing. So essentially, these are the two strategies. I'll trade them, pretty much. We'll have multiple positions in both portfolios at any given time. Strategic, usually 2 to 3 different positions over the course of about a week to a week and a half. Tactical may have a position for every day. As a prior manager said, there are so many expirations out there. We don't have to go out, a month. Like, years ago, it was one expiration per month. And then you have the weeklies, and then the Wednesdays, and now there's an expiration every day. I'm waiting for the noon expiration to come. I have a feeling the CME will find a way to make that happen, but get intraday expirations to make more volume. But we'll see. Not sure we'll trade that one, but either way, we do trade these essentially not on an everyday basis, but very close to it, especially in tactical, where it's just we like to spread the risk out over multiple time periods. Good example of, we've got a triple or technically quad witching next Friday morning. And that's a situation where you do see a fair amount of price anomalies. So a lot of times we'll kind of go heavier positions there, because you do have a lot of people trying to clean up their books for end of year, end of quarter, that kind of stuff, and they want to get away from any positions that are expiring there. So that opens up opportunities. Usually people are kind of cleaning up their deep out of the money book, and we can go in and create spreads using that anomaly. It's proven to be a very effective time to kind of trade a little heavier there. So in that case, instead of trading the Thursday or the following Monday that's based on a different future, we may come in and do more on that Friday morning expiration. So essentially, that's kind of our story. I think we fit in nicely with the other managers here. It sounds like Tyler and his team has made a great product from seeing what I've heard, and I like seeing people trade the S&P. I think it's a great product. I think there's a lot of opportunity sets for it, and so many different ways of skinning the cat, as we're hearing today.
Appreciate that, Mark, and appreciate the overview. As you described your two strategies, you led into the activity that goes into managing these two strategies. They're active. They're not sitting on positions for weeks. And being one man, maybe it would be helpful for everyone who's involved in the call to tell us a little bit about what your team looks like. Who do you have to help you with execution, with research, and so on?
Sure. So the team is myself and Scott Kemple. He's the founder of the firm. He started it. He is, I've been working with Scott since, like I said, 2002. He started Warrington in 97. I joined him when he was, was 10 million under management, and I was an unpaid intern. And, we kind of grew the business to what it has, and it's, had a lot of iterations, but it's the two of us, and we have a couple other people on our team couple of help with research, some with back office operations. So we're a team of about 5 at this moment, but between 2 products. And fortunately, we don't need a giant research staff because I don't need to know about crude oil, the intricacies of it. I mean, all of these impact the S&P. Everything. The S&P is kind of a global macro index, obviously. So I do need to be concerned with what's going on with interest rates and what is Apple's earnings going to be next quarter, et cetera, or really NVIDIA nowadays, what they're going to do. But I don't have to be an expert in that. Don't have to have a bottoms up, analysis of their earnings to make a big trade on Apple or NVIDIA, like I say. So really, it's allowing us to focus on one index and really know the ins and outs of its, what makes it tick and what's important to it, so that we can see a couple, are we overbought or oversold? There's a lot of indicators. Having done this for, decades now, there's a lot of indicators we've come up with over that time to allow us to say, hey, the high probability trade is here. So we think let's set up a put spread that's a little closer to the market because we think we're going to see a little sell-off of a X%. Things like those that have kind of honed our toolkit over the years to be able to kind of provide a value-added service.
Fantastic. Thank you, Mark. Appreciate all of that. Given the time, we're going to move right into the Q&A portion. Mark,
Great.
Appreciate you. We'll talk to you soon.
Great. Thank you. Appreciate it.
We're going to try to answer as many questions as we can. We've put a couple of these up on the slide while the call's been going on. Any questions that we don't get to, we'll set up a call directly with the person asking the question to spend a little bit more time on it. All right. Mason, what questions do we have?
Yeah. If we could kind of give our investors a picture of the portfolio weightings of each strategy, that would be great.
Yeah, absolutely. So we are not an equally weighted portfolio. Our portfolio is very purposefully weighted in terms of volatility and risk. And so the higher risk strategies, the higher volatility strategies will have the smaller weighting within the portfolio. Our intention, and this goes back to the inception of the fund, is to keep the model portfolio the same from month to month. We don't do an analysis as in, hey, we're in a strong bull market, let's reduce the long vol portion of the portfolio and more aggressively be market neutral. In other words, like I said at the top of the call, by doing that, you are extremely vulnerable to the unknown, which we had a little bit of an example for it in August, and that was not because we were playing with the portfolio, it was because of a timing issue. Otherwise, we intend to be an all-weather portfolio on any day of the week by keeping that portfolio static. And we can, there's a pie chart showing the different allocations within the fund that we can share among the 8. And then I'll go through some of these more commonly asked questions here. Is liquid? The fund is liquid. You can access a portion or your entire investment at the end of any calendar month. There's no fee to do so. I think we're very friendly on our notice period. We try to give you almost right up to the end of the month. Tax return, or why do you trade futures? The answer is cash efficiency, liquidity, and tax treatment. So futures allow us to utilize our cash more effectively without borrowing funds to leverage returns. We never have to borrow funds or endure a carry charge on our trading capital. The second reason is liquidity. The options chain in the futures market, where more institutions are trading, is much more liquid than the equity options. And lastly, and maybe most importantly to many of our investors, is the tax treatment. So unlike equities, or for that matter, fixed income, private credit, or real estate, we're entitled to what is called 1256 tax treatment because we use futures. For the end investor, that means their return at the end of the year is subject to 60% long-term capital gain and 40% short-term capital gain, meaning you keep a larger portion of your return than you would in those other asset classes. Can I access Hyperion via my broker? We're currently set up on the Fidelity Alternatives platform. We'll send out our Fidelity QSIP number following the call. If you have another broker dealer that you'd like to see us on, just let us know. We'd be happy to onboard any others. How is the correlation of the daily returns of the fund to the S&P? I would imagine they'll very closely mirror our monthly correlations to the S&P, which is negative 0.12. we can run an analysis on that and show you it's going to be close to 0 or negative. Who does our returns? Our returns every month are calculated by a third-party administrator. So there is a third-party accounting firm that does all of our returns, handles customer funds, provides your statements to you, and they're doing that on a daily basis. They're doing it on, their accounting is done on a monthly basis. They monitor the fund on a daily basis. The firm is called Hyperion. Who does our audit? Our fund is audited every year by a firm in Chicago called Ryan and Juraska. I'm happy to share those audits to any prospective investor. Thank you all for joining us today. We'll be sending out a link shortly for those interested in speaking with us and continuing this conversation. We're also going to send out a recording of the webinar for you to review further. For active investors, please don't hesitate to reach out to me or Mason directly. And thank you all for your continued support and trust in the Hyperion Fund. I wish you and your families a wonderful holiday and a happy new year. And thank you again.